Better System Trader, episode 53.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 53, and I'm your host, Andrew Swanscott. What an eventful couple of weeks we've had. The results of the Brexit decision took a lot of people by surprise, and the markets reacted accordingly. What was interesting about this event was that we all knew it was coming. We knew the date and approximate time when the Brexit votes would start rolling in, so we kind of had a rough idea when we might start seeing some type of market reaction to the results, if the market even reacted at all. Now, as systematic traders, is there anything we should do to prepare for this type of situation? Should we just continue trading as usual, following our systems? Should we override our systems for special events like this, reduce our exposure, or perhaps even switch off our systems and stop trading altogether until the results of the vote have been announced and the uncertainty subsides? Or are there any other approaches that we should consider, and how do we actually go about deciding what to do? In today's episode, we're doing something a little bit different from the usual because we don't have just one guest, we actually have 13. That's right, we've got 13 past guests of the podcast here. Actually, that's not right. We have 12 past guests and one future guest, which I'll explain a little bit later. But in this episode, they'll all be sharing their approach to the Brexit vote. I'll be asking them what their trading plan was going into the Brexit decision. You might actually be surprised with some of their answers. I'll also be asking them what factors they considered to reach that decision, whether they were happy with the approach looking back, and also if they have any key learnings that we can all take out of this experience. I personally found it really interesting to hear what they had to say, so I'm sure you will too. Now, I should also mention that I guess you could call them these mini interviews because they're only a few minutes each. I'm going to replay them in the order they were recorded. The first one was recorded on the Monday, just a few days after the Brexit decision was announced. And as we get to later interviews, they were recorded later in the week. And by that time, we'd obviously seen more of the market action unfold by then. So you may hear clues about that from some of the later guests on the show today. Before we get started with our first guest, you may remember about 2 months ago in the John Eller's interview, John mentioned a possible workshop for later this year, and I'm pleased to announce that the workshop has been confirmed. It's a great opportunity to learn all the best DSP and cycles trading techniques in just 3 days. It'll be an intensive workshop where he'll be sharing all of his research from the past 11 years. You'll learn about the spectral structure of the market, DSP techniques, indicators that really indicate, building robust trading strategies, and intraday trading strategies. Plus, John will be doing something he has never done before. He'll be disclosing the secrets to his Mesa algorithm, including the code. He'll also be sharing a number of other strategies too, along with the code for those, so it's shaping up to be a fantastic workshop. For more information, visit the show notes page at bettersystemtrader.com/53, or you can go directly to the workshop information page at bettersystemtrader.com/John Eller's Workshop, all one word. Oh, there's a special bonus there for Better System Trader listeners too, so check that out, bettersystemtrader.com/John Eller's Workshop. Now, first guest is Nick Raj. Nick is a professional trader, analyst, educator, and author, and he's been trading for over 30 years. He was a guest on episode 4 of the podcast where we discussed a number of elements of system design and also what it takes to be a successful trader over the long term. So let's get started by hearing from Nick. So what was your plan going into the Brexit decision?
My personal plan, and I'm talking about trading my own money here at the moment, was just to follow my systems. They are robust and they have been tested back, 20 plus years, and there's been quite a number of events in that period of time where the systems have been put through their tests. So interestingly enough, the mean reversion systems, which are one, leveraged, and two, more prone to short-term volatility, they actually didn't trigger a great deal because the market was strong leading into the vote. So coming into Friday night, for example, I think we only had 5 orders to go on and only 2 were filled. So it was relatively calm considering. Obviously tonight, now that the market's reversed significantly, we're going to have a lot more orders to go in. But as I said, the plan is to trade the systems as they're designed. We did advise our clients that, they should be cautious, and there was no shame in saying, I'll sit this one out. Obviously I've been in the markets for 30 years and I've got a different psychological fortitude than a lot of our retail clients. So it wouldn't be good of me to say, yeah, jump in there and follow the system, because sometimes it's best to just sit aside and see what happens. And, you just don't know what's going to happen. And I think what we've seen is been quite significant. And look, one day doesn't make a trend, but certainly days like that start new trends. So it may well be that we've got a new trend underway now. So we'll just see how it goes.
Okay, so you already kind of touched on this a little bit, but what factors did you consider when deciding on to continue trading your systems?
Well, as I said, the systems are designed to be followed. There's no point having a system if you're going to opt out of it whenever you feel like it. Now, agreed, the Brexit was significant, and perhaps, as I said, for a retail trader, perhaps there is good reason to do that. But the important thing here, Andrew, is that if you act against your system and you get positive feedback, i.e. acting against your system and the outcome was good for you, in other words, the system lost money and you stepped aside and missed those losses, that's going to reinforce the next time. And that's where you've got to be very, very careful. If you start to think, oh, I can outsmart my system, you're back in the jungle. You don't know if you're coming or going or what's going on. So I think if you speak to some of the bigger systematic traders out there, Jerry Parker and so on and so forth, that you've had on your show before, I have no doubt that, look, mind you, they're also managing money, and some of them tend to be vol targeted. I know Jerry's not, but I'm sure a lot of them would not have stood aside from their systems because they're paid to trade their systems. That's what it's all about. And as I said, if you stand aside from your system, if you take a discretionary call on your system and you get positive feedback, then that's going to reinforce that action next time as well. Now, next time it may not be something as serious as a Brexit. It might be just a little bit of added volatility in the market. And once you start overriding your system and you get that positive feedback, then you'll tend to do it more and more and more. And then at the end of the day, what's the point of having a system if you're not going to follow it?
Yep. So what lessons can we learn as traders from all of this?
Look, I just think you've got to be, you've just got to understand that this is part and parcel of trading. It's not easy. Psychologically, this is what differentiates the professionals from the amateurs. And I think having a trading system is a very good way to go. In fact, a great example was a quote from one of my students from the Trading System Mentor course. They put in the forum that they are completely relaxed, that they've got a system to follow. They know exactly what action to take, and they feel completely relaxed, and actually said that, back in the old day when I was a discretionary trader, I would be all over the place and probably lost money. And now they feel empowered. They feel in control because their strategy has been tested and they are robust, and all they have to do is simply follow along and let the cards fall as they may. And look, allowing the cards to fall as they may is the difficult thing, because they may fall as a loss, and obviously that's something that we don't want. But at the end of the day, you just have to allow the system to do what it's designed to do. And, in some circumstances, that will be a loss situation. So I guess any advice I would give, if you've got a leveraged account, just tone it down, turn it off, even the leverage, just trade a cash account. But also, look, there is no shame in standing aside and let this volatility subside, but just don't make a habit of it over the longer term.
Yep. Okay. Good stuff. Thanks, Nick. Okay, thank you, Nick. You can find out more from Nick on nickraj.com. Our next guest is Robert Babalovsky. Rob is the head trader and managing director of a privately held prop trading firm called TradeView Investments, which is located right here in Melbourne. Now, Rob's been trading for 20 years and was a guest on episode 22. And on that episode, we discussed prop trading in great detail. Plus, we also had a chat about arbitrage in there too. So if you're interested in prop trading or are a prop trader, that's a great episode to take a listen to. Now, let's find out about Rob's approach. Okay, Rob, so what was your plan going into the Brexit decision?
Basically, our thought on the desk was to reduce positions. We're really conscious of the fact that it will be a volatile period with a couple of factors. Wild swings. I mean, that wild swings don't affect us as much, being systematic and being automated. But what we thought to ourselves was, look, better safe than sorry. And so a lot of the bots that we've got that scalp, if you want to call it, 1 or 2 points, we decided to switch those off simply because of the possibility of spreads widening quite heavily. That was our major reason to reduce or stop those bots. And also the fact that the market moves, 100 points, 200 points in a few minutes. I mean, that no brokers were going to stop you out at market price. So you were probably going to get slipped a lot more than what you expected. So that's pretty much what we did. Planning. That was our main plan going into the Brexit decision.
Okay, so initially when you said reduce positions, do you mean, obviously apart from switching off those scalping strategies, were you reducing position size in the other models? Or
Absolutely, yeah.
Right.
Yeah, so we concentrate a lot about a net positioning exposure. So hypothetically speaking, going in net long or net short. And prior to Brexit or prior to Friday, it was on Friday, wasn't it?
Yeah.
Prior to that, we were net long, and we got it right in relation to the initial move up. But then when Brexit was announced, some of the bots that we had left on switched positions very quickly, and some of the bots that we turned off. We still have our the systems running in the background, but they don't take any trades. They just give us the signals, if you want to call it, your buy and sell arrows that we programmed into it.
Yep.
And, in hindsight, a lot of them got it right, but then they also got it wrong as well because the turns were very quick. And, getting stopped out, I mean, good luck, in getting stopped out at market. So that's pretty much what happened, yeah.
Okay, so you mentioned that you, when you were deciding on this approach, you considered perhaps the widening of the spreads and the slippage. Were there any other factors that contributed to you deciding on the approach that you used?
Yeah, we didn't know. It's a common thing for us here on the desk, and I continuously tell my traders here and the traders that come through us, is if you don't know, don't trade. Okay, that's pretty much it. We didn't know what the impact was going to be, so we decided to turn off a lot of the bots. We did, however, manually go back to old school manual trading, and that was quite good. But look, that's I think the biggest factor was the unknown.
And so now looking back, how do you feel about the that decision after the event?
Oh, look, it was the right decision. I don't ever, regret turning bots off or reducing exposure into an event. I don't regret it because you know what, Andrew, the way it works, right? It's very simple, right? Everybody, well, not everybody, but the majority of people will turn around and say, yeah, I got it right. Look, you know what? If it went in the completely opposite direction, then you wouldn't be saying you got it right. So to me, it's very simple. I don't regret switching things off. I don't regret reducing exposure. No, definitely not. No.
Okay, cool. And okay, so what lessons can we learn from all of this?
Look, first, if you don't understand, don't trade. 2, if you understand that the event is going to occur, you've got to ask yourself 2 questions. How exposed am I? And am I prepared to take on the risk? Okay. So from me, the lessons are quite simple, is we will continue to do what we do best, and that is trade in a systematic way because we've built and tested the models before. And 2, we actually do keep a very close eye on the markets in general on a day-to-day basis. So from a lessons point of view, I think, we did the right thing, and we're going to continue to do that at the next event, or let me put it this way, at the next known event, because I'll never be able to do it at the next unknown event.
No, that'd be nice.
So, yeah. Oh, look, it'd be nice to know before it actually occurred. Yeah, absolutely.
Yeah.
So that's probably it. Yeah, sorry, Andrew.
No, that's fine. All right. Well, thanks a lot, Rob, for your time. I appreciate you sharing your experience with us.
And no dramas. I hope it was insightful.
Yeah.
Okay, mate.
Thanks.
Thanks,
Rob. You can find more about Rob at tradeview.com.au. Our first 2 guests were from Australia, but this isn't all about the Aussies. Now we're heading over to New Zealand to have a chat with Tim Ray, who was a guest on episode 21. Tim is a proprietary trader who trades his own money with well over 100 automated strategies across 25 different futures contracts. That's right, I did say 100, but not only that, he also won the World Cup Trading Championships as well and placed top 3 in a couple of years too. So in our chat in episode 21, we talked a lot about diversification and trading with multiple systems, but he also shared his experiences dealing with the collapses of PFG and MF Global and how he approached that, which was quite inspirational. So if you're ever in a similar situation, I recommend you go and check that one out. Now let's have a chat with Tim. So what was your plan going into the Brexit decision?
Well, going back, say, a week or 2 before, I had originally sort of thought, no, I'm a systems trader, pure systems trader. I trade through everything normally. But as I got closer to it, I started to look at the issues and started to realize, wow, this could be a fairly volatile period. And that combined with I was getting emails from clearing firms saying that there was no day trading margins were going up and so forth. It meant for me to trade, I was either going to stay up at my computer all night and watch this thing to make sure I was not having any issues with, margins or them doing anything silly in closing positions, or I could have traded a reduced size. But in the end, I thought this is such a one-off event. It's just one day. Maybe I'm better off just to stand aside because realistically, it probably will get quite volatile, and that's usually not particularly favorable for the systems I use. So I just in the end decided to shut down.
Okay, so other than the margin and the volatility, were there any other factors that you kind of considered? I mean, obviously you need to get some sleep at night as well, so that was one of them. But... Yeah,
that was one of them, because like I say, I normally let my systems run and I just check them now and again, but with this going on, I couldn't really afford to just check them once every in a while. I would have to sit at the desk all night, and I don't mean to sound like a lazy dog, but I don't want to stay up all night watching the computer. But yeah, it was also a very unusual event. It was a one-off situation and was bound to, whatever happened, no matter what the result was, it was bound to have the market be volatile because you had 2 things. You had the votes were coming out they were coming out in staggered. It wasn't just one vote or a vote all or nothing. They were coming out and then you get the eventual one. So you knew there was likely to be volatility all through that period, and historically when I watched news events, no matter what happens, even if it happens, what you expect to happen, you usually see these really, I call them silly price spikes that are just going all over the place, which, can be really not very helpful for trading often.
Yeah. Okay. So I guess in your situation, you're almost kind of forced to close your positions anyway. But how do you feel about the decision to do that after the event?
Yeah, I wasn't exactly forced to, but put it this way, it did make me sort of basically have to change my plan, because my plan, even if nothing else, I'd have to stay up all night and watch it. So, I actually feel quite good about it. And the reason I feel quite good about it is that, well, for start off, like I say, it was bound to be a strange day. But secondly, this is probably a terrible thing to say, but in hindsight, when I was, one of my kind of annoying things, I thought Murphy's Law will say that if I don't trade, it'll be one of those spectacular days. Well, it was a spectacular day, but if I looked at my systems, there were winners and losers, and I haven't actually added it up exactly, but it wouldn't have been a big difference to me, profit or loss wise. So that I feel really good about, to have not had it been a day I would have cleaned up and I missed out on. So that I'm reasonably happy about, looking back. So I feel quite good in that respect. And it was also good for stress not to be trading through that. I don't get a lot of stress in trading, but this was clearly going to be a unusual event one way or the other. And so just to actually not be trading through that, like because I went and had a game of golf right when the peak of the things were on, because I had nothing to fear and what was going on.
Yeah. Okay. Do you have a plan to switch your systems back on, or are they already?
Yeah. No, they're all. The plan was to switch them all back on Monday, and I've done all that and resynchronized positions. So basically, my rule of thumb is anything that I can get in at the price or better, I enter it. The systems that are out of sync and at a worse price, then I just simply wait till the next trade or the price is back in line with entry, and then resynchronize. So I've already done that. I've already traded today.
Okay.
I mean, it will probably be relatively volatile still going forward, but not to the extreme levels we saw.
Yeah. Okay. And final question: what lessons can we learn from all of this?
Well, I think there's a couple of things. Firstly, is that even all the experts, not necessarily all of them, but the majority of the experts and majority of the general consensus was wrong, basically. And the second thing was, I think, even though I'm a pure systems trader, and I sort of generally I would say you need to stick to your systems. I think there is a time to make an exception, and I think this was one of those times. So I think that's something, maybe to take out of that.
Yeah. How do you define though what kind of time should be an exception?
That is the hard one, and that's why historically I have traded through everything. This was the difference. The difference about this one was that we knew it was coming. We knew exactly what the date was. We knew exactly, even more or less to the within reasonable time frame, what the time frame when the trades were when the news was going to come out, even though it was staggered. So we knew in advance. It wasn't like something that caught us by surprise, like that Swiss thing that caught everybody out of from that field. This was something we knew about in advance. So. Yeah, that is the hard question, but I would say I trade through everything. So I trade through the Fed announcements, I trade through the non-farm payroll and all those sorts of things. But I would say is that I believe I personally lose more money on those days than I make. And so even I have been considering whether I build that into my systems. And for example, my grain systems, I already have built in, because I know the dates historically, I know the dates going forward for each year when these announcements are going to be, the big ones. And I actually have a filter that for some of my soybean systems, for example, I simply don't trade during that period. So you can build in things like non-farm payroll and things like that if you want. But these one-off situations, I guess it comes down to judgment at the end of the day.
Okay. All right. Well, thanks a lot for your time, Tim. I appreciate you sharing that with us. I wish you all the best.
That's good. Thanks.
Thanks, mate. Our next guest is Larry Williams, who has been on the show twice before in episodes 20 and 40. Now, as a lot of traders would know, Larry holds the record for the largest return in the World Cup Trading Championships, turning $10,000 into over $1.1 million in 12 months. He's also published a number of books and created a number of indicators. Now, a bit of a warning with this one, the audio in this recording isn't too good. We did try our best to clean it up. It only lasts about 2 or 3 minutes, I think, so it's worth hanging in there just to hear what Larry has to say. Now over to Larry. So, Larry, what was your plan going into the Brexit decision?
Well, since a lot of my trading is automatic, we were just following our automatic trading strategies. And fortunately, we had to sell the day before Brexit. And it came close to being stopped out, but didn't quite get to our stop point as the market gapped up. And then, of course, it collapsed. And late yesterday, we covered our short position.
Okay, so what factors did you consider when deciding just to follow your system?
Well, years ago, I decided that if I'm a system follower, I'm a system follower. Why build systems if you don't follow them? So, it's just like, and because like all of us, I have problems. I want to override the system and stuff. My automatic trading systems are in a cloud computer, so it's very hard for me to even touch the system to screw it up. Sometimes I won't know for days if I'm long or short. I may go look or I may not look, but I found that if you are the mechanical trading stuff that I do, I just let it run and look at it occasionally. Okay.
So what lessons can we learn as traders from all of this, from the reaction and that kind of thing?
There's an overriding lesson is that if there's going to be an emotional event like this, why not have both puts and calls right before the event? And you're going to lose on which side doesn't work, but you're going to make quite a bit on the side that does work because the reaction is so dominant. I think that's probably a big overriding point. That or don't even be in the market. And the other point is I had a lot of calls Monday morning. Should I sell all my stocks on the opening? And I thought, wow, that's a pretty strong reaction. But I had a lot of emails and phone calls. What do I do, Larry? What do I do? And so when people are that emotional, they're most often wrong. So you're looking to fade the emotions of Friday and today.
What did you say to those people who asked you if they should exit on Monday?
Well, after I stopped laughing, I told them they should probably continue holding their positions.
You think it's a bit late?
Well, yeah, and a lot of stocks came back. I mean, we had stocks that we owned that made new highs Friday, and a lot of stocks. There were some stocks that were quite strong, and a lot of stocks, good growth stocks, rebounded quite well to the emotional response.
Okay. If I can just ask you one more question, because you've obviously had a very long and successful trading career, and you've traded through a number of events like this. How does this compare to others in history that you've experienced?
Well, about the same old deal, same song, different verse. It's kind of the opposite when President Nixon took us off the gold standard in 1973, I think it was, and the market had this massive gap up, and nobody knew what was happening, and a lot of emotional response. And just whenever there's a huge emotional response, my recollection of all of these, and there's been so many of them, is that typically the emotions are wrong. And in this case, we could particularly look at what the Commitment to Trader report shows. What have the large traders been doing? What's their position in the British pound? What's their position in the treasury bond or gold market? And that's the underlying strength of the market, the underlying future direction of the market. So just put those two together and you got a good idea what the future is going to entail.
If the market action's been driven by emotions and irrational behaviors and things like that, do those kind of approaches, commitment of trade and those kind of things still apply in those situations?
Oh, absolutely. Martin Luther King had a great comment. He said that America is a 10-day nation. By that, what he meant is that whatever's topical in the news today will be forgotten 10 days from now, and there'll be a new news story. And I think that relates to the emotions of the market. Whatever the big issue was earlier this year came and gone, and now it's Brexit, and, 9 days left now, and that'll come and gone. There'll be another scary issue out there that the perma-bears will try to scare the world with. So it's much to do about nothing. And we'll move on to the next scary event. Oh, interest rates are going to go higher. That'll be the next, whatever. There's always some fear factor out there that the media loves to jump upon. And this is just one more. And, in 9 days from now, we'll be on to back to life as normal.
Okay. All right. Well, thank you very much, Larry, for your time. And
my pleasure, Andrew.
And I appreciate that and all the best.
You as well. Good luck and good trading.
Thank you.
Thanks so much.
Bye-bye. If you want to hear more from Larry, check out his website, ireallytrade.com. Lawrence Bernew is our next guest. He's a dedicated short seller who spent years working in the hedge fund world before leaving to trade his own strategies and travel the world with his family. He has a wealth of knowledge on short selling, so if you want to hear more about that, he is featured in episodes 32 and 44. Now, this one also has poor audio. Sorry to hit you with two in a row like that, but I think this is the last one. Or actually, there may be one a bit later as well, but this doesn't go for long, so let's see what Laurent has to say. So what was your plan going into the Brexit decision?
I mean, the market was pricing that the UK would stay in the EU, but still there's an indecision because democracy is a very dangerous and powerful tool, particularly in the hands of the masses. So I didn't know how it would go, and my plan was to basically buy a straddle, like buy out of the money, calls and puts, and bank on the volatility. Unfortunately, I was not the only one with that kind of idea, so it was actually priced quite high. The near month was priced high. But the overall idea was to reduce exposure, not to take risk. You never know how it will turn out, but use volatility in those cases.
Yeah. So when you say reduce exposure, were you just reducing the position size or the number of trades as well?
I didn't trade the entire week. So, I mean, on DTF, I didn't trade. On the Forex, we reduced risk so that when the volatility increased, the algo picked up on it. It gave small position size. If it gives too small position size, orders are rejected automatically. So the algo goes mute and it just follows the sequence of the existing positions. So we reduced risk quite dramatically on the Forex, and we weathered the storm quite well, actually.
Okay, excellent. So what factors did you consider when deciding that would be your approach?
Very simple. I mean, for instance, when it's the Fed, they're fairly predictable in their behavior. When it's a referendum with uncertain upside but quite clear downside, and when the poll are quite tight like this, I thought, yeah, you know what? There's uncertainty. There could be a left tail event, which happened. So my position is always to reduce risk. Always be on the cautious side. Concentrate on how much I can lose, not how much I could make.
Yeah. What about from a systematic or algorithmic trading perspective? What lessons can we learn?
Okay. What was interesting is that there were lots of the market was clearly asked this is just a formality the UK stays in and so on and so forth. And the way to trade this is to bank on volatility. Obviously, I was not alone doing this, but this is going to be volatile either way. The UK had stayed. We might have gone up 1-2%, everybody happy, but then plateaued for a while. In this case, the market just resetted it. And the way we approach it is we want to really reduce the risk, live to trade another day.
Yeah.
So this is really our approach. And our algo picked up on it. He did a wonderful job. We barely lost a little bit because we were actually the other way still, but we barely lost. So it was very good. It was a very good test of volatility and now we picked up on whatever we lost, we're making it back today. So we reduced the risk.
Yeah. All right. Well, thank you very much for your time today and for sharing that. It's much appreciated and all the best.
Thank you.
Thanks, Laurent. If you want to hear more from Laurent, his website is alphasecurecapital.com. Our next guest is Gary Stone, who's been trading for almost 30 years, and his work has been widely quoted in TV, radio, and print. He was a guest on episode 8, where we talked about market timing in great detail. So let's hear about Gary's approach to the Brexit. So Gary, what was your trading plan going into the Brexit decision?
Andrew, the trading plan was exactly the same as it always is. So there are no special clauses or any additional points that we added into the trading plan that we should do anything differently whatsoever.
Okay, so what type of factors did you consider when deciding that you were going to continue with that plan?
Well, as you know, I'm a 100% mechanical trader, and which means that the trading plan is very rigorous and structured according to the research that goes into coming up with the rules that we have in the trading plan. So when we do our research, and we do it on 20, 30 years of historical data, there would be a whole bunch of different variables. When I say a bunch, probably thousands, maybe even millions of variables that go into the historical price movement that we research. And obviously in that length of data, there would be Brexit type events that would have occurred, not exactly the same as Brexit, but events that have similar effects on into trying to come up with special rules for special events that are going to be different in the future. So effectively, we've researched, and I'm sure a lot of other people do this, the price movement, which has these sorts of events built into them, and whatever the price action was that was on at that particular time historically on those events that were included in the historical price data is what we use going forward. So to us it is just normal, random short-term price movement, just for a different reason.
Okay. And so how do you feel about that decision to continue trading now that we're after the event, or perhaps the initial move of the event?
Absolutely no different. I'm not going to change anything. Firstly, our overall market risk on one of our systems gave an exit signal to us to take us into high market risk status on the 14th of June. So that was some 10 days before the event, which meant that we had very low exposure to the market anyway during the event. That was our medium term system, which is obviously a bit more sensitive to price action. So we were mostly out in cash. Some of our customers and ourselves would have been near to 100% in cash or totally 100% in cash. So our longer term system, which focuses on large cap stocks and ETFs, exchange traded funds, some were in and some were out, just based on the price action of leading up to the event. And after the event, we've now closed the positions based on mechanical exits, but we still got two very large positions that are open, both here in Australia and the United States, which have kind of just sailed through the event. That's just the nature of that particular exchange traded fund that's taken the volatility in its stride.
Okay, if I can just ask you a question about your modelling then, because I know you don't trade the futures markets, but you discussed price action there, and I was watching the futures markets at the time, and the price action was only giving you part of the story. So I'm just wondering, with your modelling and the results that you experienced during the past couple of days, was there a large variation in expected and actual, or what did you find there?
No, not really. I guess there was one surprise. One of the more volatile exchange traded funds. I mean, these markets are highly liquid instruments. So talking about exchange traded funds on the mainstream indices and some of the international indices. One of my favorites is the Brazilian index. The ETF being EWZ. Does 2 to 3 times the daily liquidity or turnover of what BHP does in Australia. So it's big. It's typically a more volatile index. The ETF's typically more volatile, but during this period, it's probably been less volatile than the mainstream indices, despite all the things happening in Brazil. So that's a surprise to the upside rather than the downside.
Yep.
And again, it just goes to prove anything can happen. For us to and to keep that neutral mindset is important, and that's what I think is important for mechanical traders. At the moment we start imposing what we think's going to happen ahead of the time, that just takes us out of the execution of our plan, the way we should execute it, and then we start bringing discretion and subjectivity into it. And then why be a mechanical trader in the first place if that's what you're going to do for special events? If you justify it that way, it's just, in my thinking, it's just the wrong thing to do.
Okay. Well, you've just kind of started answering this question, but what lessons can we learn from all of this?
Well, the lessons that we can learn are, and it's not so much new lessons. I think it's confirmation of old lessons. Is that anything can happen, and leading into this, I think I haven't seen or read anybody saying that they predicted it was going to happen, a week out or even 2 days out. I think just about 100% of commentators were of the view that it wasn't going to happen, or pretty close to it. If it wasn't 100%, it would be pretty close to it. So the event, the outcome surprised so many people, and it just goes to prove that anything can happen, and that going into any event, no matter how much of a dead cert you think it is, it's always best to keep your mind open to what if the opposite to what everybody's expecting happens, and what should I do about it going into it, and to to not bank on the dead cert, if you like, and leverage up and put more money in because you think this is such a dead cert. You just got to stick to the plan and execute it as you intended, away from the heat of the moment. I think that's one thing. The other thing is that short-term volatility is going to happen in the markets. But every time it happens for a different reason, and we don't know what that reason is going to be in advance going into it. And I think preparing ourselves mentally for that helps us accept and surrender to that. And and if you're doing some modeling, then don't model just the good stuff. Go and model the high volatility times and see how your models. And there's lots of examples of it. See how your models stand up to those of the historical data, and how you might not curve fit or do something special to handle those, but make sure that somehow your timing and your mechanical systems can handle those as well as the good times.
Okay, great points there. Thanks a lot, Gary. Thanks for your time today. I appreciate you sharing your experience and your knowledge with us. Cheers.
It's a pleasure, Andrew.
If you want to hear more from Gary, his website is sharewealthsystems.com. The next guest hasn't actually been on the podcast before, but we do have something prepared to release very soon, so look out for him in the next few weeks. That guest, though, is Adam Grimes. Adam has 2 decades of trading experience and is currently CIO of Waverley Advisors. So what was Adam's approach? Let's take a listen. So Adam, what was your trading plan going into the Brexit decision?
Well, I think with any event like this, when we are fortunate enough to know that something might happen versus the times we just get blindsided, the thing to think about, of course, is the volatility. And to respect the uncertainty, to respect the fact that you really cannot possibly plan for the degree of volatility you might see. The other side of this, and I think what makes it so difficult, is that so many of these anticipated events turn out to be non-events. So there is there's a tendency toward complacency, I guess, and the vast majority of the time that's correct. When it's not, we have an event like this. So the positions that we were looking at, most of those had the stops had already been tightened and they were liquid markets. So, not a situation I would have been very uncomfortable holding positions where I would have not been able to access the market. But, looking at something like currencies or stock index futures, no real issues there. Had we not been in that situation, and certainly in other similar situations, I would look at manually reducing position size, even though that might be a little bit outside the parameters of the system.
Yeah. Okay. So, kind of an obvious question there, but how do you feel about the decision just to leave those trades now that the that initial part of the event has passed?
Well, I mean, you come into an event like that, and you're looking at long positions in the S&P, and so I mean, in retrospect, they were the wrong positions, but the long gold position more than made up for the losses. So I think for me, if I look at these events as a whole, I will have the best performance if I simply follow my methodology. I guess we should be careful with the word system, but if I follow my methodology with discipline, and this might have been the 1 out of 10 where I would have been better off going in and manually adjusting things, but it's the proverbial slippery slope, because once you do that, you start thinking you're smarter than you are, and it kind of becomes a license to start pushing things around. So, given the same situation, I would do the same thing.
Okay, great. And are there any other key takeaways or lessons that we can learn from all of this?
Well, I think we talk about fat tails, and everybody knows about outliers. Everybody knows about the weight in the tails. And by the way, as a little aside, anybody who's throwing around statistics that are generated from a normal distribution, it's just ridiculous. I saw something. This move in the British pound should happen once in every however many zeros a year. And obviously, that's absurd, and that proves if you think that means anything, then the way you're measuring things is wrong. We all know that. But the lesson back where I was headed, the lesson of fat tails is you have more stuff, more weight in those tails. You also have more weight around the mean. So this is a quantitative lesson that has behavioral implications, and it goes back to what I said at the beginning, that you have more boring outcomes. You have more things where more days, more weeks, more events where markets don't really move, and it's very difficult to be prepared behaviorally and psychologically for just what can happen in the tails, and for the fact that a major market can have a 10 sigma event. For those of us who trade individual equities, individual stocks with a fair degree of regularity will have 15 sigma events. So these things certainly happen, and it's kind of a mixed message to make sure that your methodology accounts for and encompasses these crazy, terrible, unexpected, or great, depending which side you're on, unexpected events, but also realizing that there's a behavioral challenge because a lot of times nothing happens. And the only solution, I think, well, I shouldn't say that, maybe there are some seat of the pants, very instinctive traders who can put all of this together. But I think this is really, the times like this really bring into focus the importance of having a disciplined methodology.
Excellent points there. Thanks, Adam. So I appreciate your time and your comments today, and I wish you all the best.
Same to you. Thank you very much.
Thanks, Adam. You can learn more from Adam at adamhgrimes.com. The next guest has been on the show a few times before, but not as many times as he's won the World Cup Trading Championships. That's right, Andrea Unger, 4-time World Cup Trading Champion, is our next guest. He was featured on episode 16 and 45 of the podcast. Have a listen to what he has to say. So, Andrea, what was your trading plan going into the Brexit decision?
Oh, that was a hard decision. Actually, my plan was to skip trading. I trade automated systems, and these systems take advantage of, let's say, sort of statistics of a market. They try to look into the behavior of a single market, and then they try to apply something that leads me to make possibly some profits. When things happen, such as the Brexit, all markets go crazy. And the risk is too high, not only too high, the risk, which is normal because, the shock can be great, and it was. But the point is that whatever moves comes out, probably that move has nothing to do with the specific identity of the market. And if the market moves in a way that is not its common way of moving, then also my systems will probably face difficulties in getting the right spot. So I think it's sort of useless, not only risky, which it is, but also useless to go on something that looks into the statistics on a day or some days where the statistics are most likely broken.
And were there any other factors as well that you considered when deciding that you'd stop trading for the short term?
Oh, yes, because whenever I decided not to stop, I was terribly hit by the market. So I said, no, this time I want to stay quiet.
Right, okay. So how do you balance that, though, being a systematic trader based on statistics and then using some discretion for when to stop and start? How do you determine when you should do that?
Oh, that's just common sense. I have no real plan, no mathematical plan to do that. Just a question of being, let's say, open-minded enough to understand when it's not time to let the systems run. And this was, in my opinion, the right moment to stop them. So there is I don't have plans for the future. For example, if something comes out which I estimate too dangerous, to stay in the market, then I will switch them off, and it's made time by time.
Okay. And final question, what lessons can we learn from all of this?
Well, now if I look into the performance the systems theoretically made during the Brexit, it was not that bad. I would have even made some money, not a lot of money, because I had systems which were long and systems which were short overnight on the DAX future, just to mention one which moved heavily, And the British pound was flat. My system was flat on the British pound, which is a coincidence, obviously. It's not due to the Brexit. So what I can look at is say, okay, I was not hit. The long system on DAX was obviously heavily hit at a loss of about 25,000 euros, and that money was made back from the short system. So the message I get once again is how important diversification is in trading systematically. It's very important to have a clever and broad diversification of a market's time frames, methods, and so on, so that whatever happens, somewhere you are in the right direction anyway.
Okay, well, thank you very much, Andrea, for sharing that with us. It was very informative.
Well, thank you for inviting me, and next Brexit, if there is one, I will be back with you.
Okay, great. Happy trading.
Thanks, Andrew. Bye, everybody.
Andrea's website is oneyeartarget.com if you want to learn more about him. Thanks, Andrea. Our next guest is hedge fund manager Andreas Klenow, author of the books Stocks on the Move and Following the Trend. He was a guest on episode 13 where we focused on trend following in stocks. Now, the audio in this episode isn't the best either, but it's the final one with poor audio, so hang in there, they're all better after this. Over to our chat with Andreas. So, Andreas, what was your trading plan going into the Brexit decision?
Well, we have a lot of different mandates and a lot of different strategies, and it varies quite a bit because some of them have very clear mandates. Some of them are rule-based, and if they're really rule-based, well, you follow the rules. Others are more discretionary kind, and then you can react a little bit differently. Now, what was interesting here was that the rule-based mandates actually took positions in favor of a Brexit in advance. Nothing to do with our opinions at all. It's just the way things looked. Of course, we went into the decision heavily short European stocks. We were short the pound, short the euro, long the bonds, long gold, long yen. This was just a positioning that's been building up over the year. Those positions didn't look very fun to have on Thursday, especially Thursday afternoon. Things looked very much like the stay side, the remain side would win, and that looked like we're going to take a hit on Friday. As it turned out, well, we didn't. On the more discretionary side, we reduced risk. We had on long exposure in the US, which was the only thing that really hurt that day, but balanced by a lot of shorts in Europe and longs on the commodity side. But we reduced risk overall on the discretionary mandates where we can, basically. But the systematic mandates, well, they have the rules. They follow the rules.
Okay, so you've kind of got two different approaches there, I guess, depending on the type of strategy. So what factors did you consider when deciding on the approach to use there?
On the discretionary side, well, the interesting thing there was that if you look at the situation we were in on Thursday. This is before the referendum, or rather the day of the referendum, so we still don't know the results. On the day, everybody was speculating on the Remain side winning. This means essentially that either we get another normal but positive day on Friday if the Remain side wins, or we get large moves down if there's a shock outcome, which, well, as it turns out, it was, of course. That means you have an asymmetrical risk, and that you have to take into account for a discretionary mandate. Either you gain a little bit or you lose a lot. That probably means you want to reduce your positioning a little bit.
Okay. So what kind of lessons can we learn from all of this?
Well, you could say, I've seen a lot of articles from systematic people. I'm primarily, of course, a systematic trader. I've seen the argument that the market predicted what's going to happen because of the falling bonds, the falling European markets, the rise in the gold and so on. But the market doesn't predict anything. Nobody really believes that. Nobody in the business really believes the market is kind of predicting something. The market is betting on something, right? Most of the year we knew there was a trouble. There was a problem. This was priced in. But the past few days the market was completely wrong, of course. All we can do is we follow our rules, we make a trading plan, we try to stick to it. As it turns out now, this whole event was dramatic for a few days, but we're already seeing a normalization. Europe is still in the bear market, of course, but I say the main thing is you gotta if you know that you have a significant binary event upcoming, and you have the ability to change your risk, as in you have discretionary mandate. Reduce the risk. It's a binary, and we just don't know. You flip a coin. Why would you want to have on larger risk than you need to on that?
Yeah, that's a good point. So thanks for raising that one. So thanks a lot for your time today, Andreas, sharing that with us, and we appreciate it, and all the best.
Thank you for having me.
You can find more from Andreas at followingthetrend.com. Our next guest, Ernie Chan, manages a hedge fund as well as individual accounts. He's also published 2 popular books called Algorithmic Trading and Quantitative Trading, so let's see what his approach was and why he decided to do that. So Ernie, what was your trading plan going into the Brexit decision?
Well, our plan is always to expect volatility. We didn't know which direction the vote will go, but one thing we know with some certainty is that there will be volatility, one way or the other. And so the plan was to suspend all the strategies that are short volatility and kept all the long volatility strategies running. And we also liquidated all positions actually we did liquidate all the positions in our portfolio prior to vote because, again, we would not know the direction it would go.
Yeah. Okay. So other than volatility, was there any other factors that you considered when you decided to take that approach?
No, it's the volatility is the only factor in this particular situation. It is we do not wish to make any directional bet on such a situation. So the only direction we want to bet on is the increase in volatility.
Okay. How do you feel about the decision to trade that way after, now that the event has passed?
The decision turned out to be a good one. We made money on the long vol strategies and flat, of course, on the short vol strategies. And this is not a particularly unique situation. We have faced many crises in the past, and we have learned throughout the years that this is pretty much the only sensible plan that we can follow.
Okay. So, final question, what lessons can we learn from all of this?
Well, the lesson, I think, is that as traders, we are not equipped to predict direction most of the time, especially if we anticipate a macroeconomic or geopolitical event, whether it is interest rate decision or oil inventory report or election results. Even if the polls say one way or the analysts say the other way, we just cannot make bets based on those prediction and estimates. Direction is extremely difficult to predict for prices. However, volatility, as I have been emphasizing in recently, is extremely easy to predict. It is amazingly easy to predict the direction that the volatility can go with any kind of models. So it is much easier to make a living trading on volatility than on direction.
Okay, so do you have an approach to decide when to switch on the strategies again?
Well, this is the only area where we would manually override our automated models because the automated models doesn't know that there's an important vote coming up, right? So we have to intervene, and we always intervene in times like this where you have a special situation where the model doesn't know about. Examples would be, the rate decisions by the central banks. The others would be, let's say, a Greek parliament vote or U.S. presidential elections, and so on and so forth. So whenever such extraordinary macroeconomic or geopolitical event come up, we will disable, suspend short volatility models.
And how do you decide when to enable them again?
After the event is passed, maybe after a day, the day afterwards can still be volatile, as we saw. Last Friday was very volatile, and Monday was still volatile.
Yep.
And so at least I would say wait 2 days, but sometimes longer might not be a bad idea. We observe that the volatility continued to today. The price, the return, the absolute value of the return is still higher than average. So it appears to me that the repercussion of the vote has not yet died away yet. So I would say that it's better to err in the direction of caution and suspend for short form models until we observe that the actual volatility has dropped.
All right, Ernie, thanks a lot for your time today. I appreciate you sharing that with us, and I wish you all the best.
Thank you, Andrew. Hope to see you soon.
Thank you. Thank you, Ernie. You can find more from Ernie at epchan.com. Okay, so we're getting pretty close to the end of our guests now. We only have 3 to go. And the next guest is Andrew Gibbs. Now, Andrew was a guest on episode 35 of the podcast, and on that episode we talked about volatility and trading the VIX, so very appropriate when talking about the market reaction to the Brexit. So let's hear more about Andrew's approach. Andrew, what was your plan going into the Brexit decision?
Well, personally, it just comes down to following what you're already doing, but you have to have a look at a few things, such as what did we know going into the decision. So one thing we knew is that margin requirements were going to increase because of the expected volatility. So that's something you need to manage if you trade lots of different systems or you trade close to your margin limits. So it's something to keep in mind. The other thing we knew was that it was going to be close. And I suppose the expectation was that if it was a Remain vote, markets would go up. And the other thing, if it was a Leave vote, then markets would go down. So that's really all you could know going into it. There's no real way of knowing what the result was going to be ahead of time. So I guess it comes down to a trading approach. And with the volatility in the market that day, well, obviously intraday trend following approaches would have been particularly good, whilst intraday counter trend approaches were probably particularly bad, especially if they didn't utilize stops. So, I mean, for me, nothing I do is particularly leveraged, so it didn't really make a difference. It was just business as usual and come what may. But yeah, certainly if you're trading heavily in margin or leverage instruments, then you needed to be a little bit cautious, I suppose.
Yeah. Okay. So you just continued trading right through the market volatility.
Yes, that's right. I mean, a lot of the stock systems are non-leveraged, so you just cop any downside and you hope that there's upside, but whatever, it doesn't really affect you that much. In terms of the future stuff, well, that some of the systems that I've got are long only, so the index systems certainly took a bit of a dive on the day, but those systems I know can have large losses, so the leverage is managed, and they're not really leveraged to a large extent, so the drawdowns are manageable and within the risk constraints. So it's just about having a money management plan in place before you go into it. So yeah, some systems won, some systems lost. I think overall I finished in front, which was good.
Yeah, and so you also trade some volatility strategies, if I remember from our last podcast interview.
Yes.
Did you consider doing anything with those approaches, or were you happy just to continue trading those through?
I just traded those through. So even though it's one particular strategy just trades short VXX on a fairly short-term basis, and that actually entered a short position on the following day, and that position's well in front, so that was good. But I track all of my strategies now using the Collective 2 software. So on the Halifax website, you can see all of the systems on there that I show anyway, so people can follow along in terms of the performance.
Yep. Okay. And so, what can we learn from all of this?
That's a good question. I suppose. I mean, it was different to the Swiss franc announcement in that there was no super huge gap which cleaned everybody out. It was all fairly well covered by the media all the way through. So even though it was a big move, most people, if they had stops in place or needed to get in or out of the market, could easily do so. And I guess the other thing to take into it is that all of the action happened in the Asian session, which was quite nice for us, whereas the Europeans and the Americans had to stay up a good part of the night. In terms of what we can learn, I don't know. Anything can happen. I suppose it's kind of like playing Russian roulette. Sometimes curiosity killed the cat. I guess we'll see the same thing when the US election comes up as well.
Yeah, that's right. Yeah. Okay, Andrew, well, thanks for sharing your experience with us today, and appreciate your time, and all the best.
Yep, okay, thanks for the interview. Cheers, Andrew.
You can find more from Andrew at halifaxonline.co.nz. This next guest is our most recent guest, actually. He was on the previous episode sharing market internals with us, and then he was also on episode 43 discussing breakout strategies. That guest is Thomas Nesneedle. Let's hear what he has to say. So what was your trading plan going into the Brexit decision?
In my case, I decided to close all my positions and to stay away of the markets on the day of Brexit. And I think that it was a clever decision. I don't always switch off my trading systems on occasions that can have some significant impact, but in this case, I really was a little bit worried of anything that could happen, and the level of uncertainty was very high to me, so I rather decided to go completely flat and didn't have open position on Brexit Day at all.
Okay, so other than the uncertainty of the event, what other factors did you take into account when deciding on your approach to switch your systems off?
I think it's quite obvious. I was especially worried about the volatility because in cases like this, the volatility can be really huge. And I think that my stop losses just are not, in many cases and in many trading systems, are not well prepared for very, very steep increase on volatility. And also from my previous experience in very special occasions like this one, there can be huge spread between bid and ask, so slippage can be really significant. And I've already experienced some huge slippage on different occasions, which was also very impactful in the past. And I just didn't want to risk this kind of situations and additional risks that are not necessary to have and to cope with.
Okay. And so what lessons can we learn from all of this?
This is actually, I was really thinking about this because I also talked to some other traders, and I know that some traders, they stayed with all their positions and they didn't close any trade, and they even didn't reduce their exposure. They went through all the Brexit day in some way. And it's very interesting because I talked to some traders, and some of them, they just tell you, and I have to agree with that in past we also had situations like this, very, very specific moments, special moments with high volatility impact, with situations that were highly unpredictable. And because you included them in your backtesting, you should theoretically stay with these kind of uncertain situations in your live trading as well. And I also heard from other traders, and this is something that I can confirm from my own experience, that on special occasions like this, sometimes you make a lot of money, sometimes you can lose more than expected. Actually, in the past, I usually lost more than expected by slippage and high volatility. But in the long run, it just averages, and it's a zero-sum game. One day you make a lot of money on occasion like this. One day you lose a significant amount of money on occasion like this. But overall, it doesn't matter if you stay with your position or if you don't. If you think about it from this perspective, then I think that you probably don't have that much to gain in highly risky situation like Brexit. So it definitely makes, in my case, in my opinion, in my point of view, it makes more sense just go completely flat and don't risk any additional stress or additional unpredictable situations, because in the long run, you will probably not make anything special from them. So why to keep on this high level of risk?
Okay. All right. Well, thanks very much for sharing that with us, Thomas, and I wish you all the best.
Thank you very much for having me here today. Thank you, Andrew. Bye-bye.
Bye. Thomas can be reached through his website, systemsontheroad.com. And our final guest for this episode is Rob Hanna from InvestorQuant. Before InvestorQuant, he actually published research on his website's overnight edges and quantifiable edges. Over to Rob for our final chat. So Rob, what was your plan going into the Brexit decision?
Well, I normally don't adjust my plan going into news events like this. But as we approached that night, I did have a few things that I adjusted. So, and it depended on the system I was trading. So for instance, I had a swing system that signaled an exit as we approached the close, the night that we were going to learn the Brexit decision. And that swing system, I typically take the exit at the next day's open. So knowing there was a big decision, I decided I wasn't going to hold the whole thing until the next day's open. And I took half of it off, which turned out to be a dumb decision. I should have taken the whole thing off. But it was, I got that little run up and I got a profit there, taking half of it off. So that was one decision I made, and just kind of reduce my position ahead of that news. And really, I probably should have reduced the whole thing. And then there was some other adjustments. So for instance, that was with a swing system I have. But then interestingly, overnight edges, I did get a trigger there for a short. And I decided, unless the evidence was overwhelming, and even then I'd be having trouble taking it, I was going to be extra finicky as far as taking a trade ahead of the Brexit. So I did not take that trade. It was kind of a borderline one anyway, and I decided not to do it. As it turned out, it would have been entered with, I can't remember the size of the stop. It would have been like 16 or 17 points. And after hours, it went up about 14 or 15 points. So it would have come close to stopping me out before turning around and going in my direction massively. But the target on that trade was a 6-point target. So if I was to make 6 points out of, what could have been a 100-point win, right? Right on it wouldn't have been that big a deal. And frankly, going for 6 points, knowing that there's going to be this massive volatility, just seemed like a stupid thing to me. Because of the fact that, I'm not going for a big win here. even if it's going to go in my direction with the volatility, there could be an easy stop out. And so that's kind of why I avoided that there. But I didn't change anything. I didn't change anything else. We did have some intraday systems that triggered the next morning when we were coming into the big gap down, and I just played them as normal, and that worked out okay. I did do some research overnight, though. A lot of times what I'll do is if I see something like this occurring, I will try and anticipate how the reaction has been historically. So I ran some studies looking at what happens when the S&P 500 gaps down between 3 and 4%, and at one point it was down between 4 and 5%. So I ran a study on that as well, just to see is it generally an overreaction, and most of the time it has been when you've had that big of a gap down. So I was anticipating that we could get a bounce that day, and if I had long systems trigger, no sense not taking them, especially since they would have had stops, most of them. And then after that first day, I had some swings set up, which did work out nicely.
Yeah. Okay. So you mentioned there that volatility was one of the factors that you considered. Was there anything else that you were thinking about that helped you to decide on the approach of, I guess, switching some off and keeping others on?
No, it was really a system by system basis, and really this is one of the first news events where I've traded and changed decisions prior to it. I do make adjustments for my overnight trading. I tend to be extra picky if we're going into what I know is a known news event, such as employment report. So going into the employment report, I know that news is coming out before the market opens the next morning. My typical exit is at the market open. So I know the trade is going to last through that. Therefore, I really only want to take those trades when they look very strongly in my favor. So it was, for me, I looked at it almost like, an employment report on steroids, where I take the same kind of approach, but knowing that the volatility is going to be, much greater than, a little jiggle from the report.
Yeah. Okay. And final question, what lessons can we learn from all of this?
I guess from my swing perspective, it would have been a better idea to take the whole thing off, because there is an unknown news event. I already had the exit signaled. Now I know it's generally taken the next day, but getting out a little early and giving up a little bit in profits, or what would probably potentially be a little bit in profits, not a bad idea, especially since we ran up so hard into that Brexit announcement, right? So that even if the vote went the other way and the market then continued higher during the night, a lot of that excitement was used up during the day. So you probably wouldn't have gotten the same bump up the next morning that you got as big of a bump down. The energy was used up to the upside pretty much. So those long trades should have been taken off. One thing I was a bit surprised with was a lot of times I will go short volatility into things like this. And I had a small short volatility position as well. And I'll generally hold through because of the fact that when there's an announcement coming, everybody worries about it. And even if the worst case scenario happens, well, now that uncertainty is gone. So you'll often see the VIX decline. And it has over this week as we've gotten a bounce, but the reaction in the VIX and implied volatility was pretty big. I think because it went the other way too quickly when people thought the vote was going to go in the favor of stay or remain.
All right, thanks, Rob. There was some great observations in there, so thanks for sharing that with us, and thanks for your time today, and I wish you all the best.
Thank you. It's always good talking to you, Andrew. I always enjoy it.
Cheers. Thanks, Rob. Thanks, Rob. Rob can be found at investorquant.com. Okay, so that's it for the guests now. Rob was the last one. I'd like to thank all of the guests for participating, sharing their approaches, reasons, and insights. I think it was really interesting to hear all the different options, from trading through the Brexit to reducing exposure, to stop trading altogether, and even to switch off particular types of systems like scalping and directional systems. So which one is the best approach? Well, I'll leave that up to you to decide, because I think the key point here is to find what suits you best and do that. All the guests we've heard from today are successful traders, but they provided such a wide variety of approaches and reasons or justifications on why they chose that approach. But they all had conviction in their decisions, they executed based on that, and they took responsibility for their results. Anyway, I hope you found some value in hearing from our guests today. I know that I found a lot of value in it, so I hope you did as well. The next episode will be back to the normal approach of just one guest, so I look forward to sharing that. All the best with your trading. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.